Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Before earnings. This article was written by KM Capital. Summary. Pause. Microsoft is rated strong buy due to substantial undervaluation and robust earnings growth and revisions momentum ahead of FQ2 2026 results. MSFT trades at a forward FY 2029 PE of just 17, with forward PFCF nearly 20% below the historical average, signaling attractive entry levels. Consensus expects double-digit revenue and EPS growth for FQ2 2026, with Wall Street target prices implying significant upside and limited downside. Technical setup is favorable, with MSFT near oversold territory, while AI and cloud investments, validated by the recent U.S. Air Force contract, underpin growth. Despite Microsoft, MSFT continuing to deliver positive earnings surprises and revisions over the last few months, the stock is down by roughly 12% since my previous bullish write-up. Since there were no notable fundamental reasons behind this sell-off, I consider it to be highly sentiment-driven. For me, as a long-term investor, the dip presents a compelling buying opportunity because MSFT looks very attractively valued at the moment, with the forward estimate FY 2029 PE ratio of just 17. The company releases its FQ2 2026 earnings next week, January 28th, which can be a solid bullish catalyst due to several solid reasons. Therefore, my take is that MSFT remains a strong buy. FQ2 2026 earnings preview. According to consensus estimates, Microsoft's FQ2 2026 earnings release is expected to be marked with a 15.3% year-over-year revenue growth and a 21.4% EPS growth. Such a setup of both revenue and EPS delivering double-digit growth is a solid one. It is also fortified by the fact that Microsoft's bottom line is expected to demonstrate more aggressive growth than revenue, meaning either strong operating leverage or robust cross-selling momentum. Microsoft's historically strong ability to deliver more aggressive bottom-line growth compared to revenue is likely to be one of the important reasons why MSFT is a Wall Street darling. Indeed, no matter which time horizon we select from the table below, we can see that net income has been consistently growing faster than revenue. There are a few reasons from multiple perspectives why I am confident that MSFT is able to deliver double-digit revenue and EPS growth for FQ2 2026. If we look backward, there is a powerful earnings growth momentum. According to quarterly income statement dynamics, Microsoft's revenue and EPS were growing at double digits over several quarters in a row. The power of earnings momentum is important, especially for a company with great visibility like Microsoft, due to its highly diversified business mix and large customer base. Another solid backward-looking reason why I'm confident that MSFT will beat consensus estimates is the company's status as earnings champion, with 11 double beats in a row. Proceeding with forward-looking factors, I would like to start with the quarterly earnings revision setup. We can see above that the picture is quite bullish, especially from the EPS revisions viewpoint. I think that such a bullish stance from Wall Street analysts is justified by the readiness of businesses to significantly increase investments in AI-powered products in 2026 due to the expanding number of cloud and AI use cases across various industries. As one of the cloud infrastructure giants that invests billions in R&D, Microsoft looks well-positioned to capitalize on the power of AI narrative. The company continues ramping up its R&D spending and has the potential to continue investing more in innovation considering its robust balance sheet. The company doesn't disclose exact amounts invested directly in developing cloud and AI capabilities, but I believe that given its status as a rapidly growing industry, most of Microsoft's R&D spending growth is attributed to this thriving area. And we see that these investments bear fruit not only because of Microsoft's cloud business's rapid growth, but also due to a major recent validation victory. The company recently won a $170.4 million contract with the U.S. Air Force to supply Azure cloud services. While the contract's dollar-wise value is peanuts for a $3.3 trillion company like Microsoft, it gives a solid validation boost to its cloud business, which is in fierce competition with AWS and Google Cloud, supplying the U.S. Air Force. Air Force is a great validation boost because it means that Azure is a highly reliable service that can handle highly demanding national security standards. Finally, the technical analysis setup also looks very favorable before the upcoming earnings release. MSFT's 14-day RSI indicator currently stands at just 33, very close to the oversold territory, meaning that investors are quite fearful before the upcoming earnings release. It is a favorable setup because it means there are highly likely no unrealistic expectations regarding the company's FQ2 2026 earnings. Valuation analysis. Since there were no notable fundamental reasons, no negative earnings surprises or downward earnings revisions, behind a double-digit share price decline since my previous write-up, Microsoft's valuation has become even more attractive. The company's forward PE ratio setup looks extremely bullish, as the multiple is expected to dip from the current level of around 27 to below 17. Of course, this contraction is not guaranteed and will depend on Microsoft's actual financial performance. However, the company's flawless earnings record over multiple years, together with strong earnings revisions momentum due to structural tailwinds, makes me confident in this forecasted PE compression trajectory. Furthermore, Microsoft looks substantially undervalued from the P/FCF ratio perspective. The company's current forward P/FCF ratio is lower than the historical average by almost 20%. Despite not being as popular as the PE ratio, I think that looking at the P/FCF multiple is also reliable for mature and highly profitable companies like Microsoft. Moreover, let's not forget that Microsoft's current free cash flow is under temporary pressure because of the aggressive AI infrastructure build-out phase. Once peak investments in data centers are over, the P/FCF multiple is poised to compress significantly. Finally, my thesis regarding substantial MSFT undervaluation is also supported by Wall Street's average target price. Consensus target price is almost $619, implying a massive upside potential. It is also vital to highlight that the lowest target price from the range estimated by Wall Street analysts is $450, which is almost the same as the current actual share price. It means that even the most cautious analysts see limited downside from current cheap levels. To conclude valuation analysis, there are multiple indications that MSFT is significantly undervalued at the moment. Mitigating factors. Based on my fundamental and valuation analyses, I can confidently conclude that the double-digit share price decline over the last 3 months was highly likely purely sentiment-driven. It appears to be the major risk for investors at the moment because weak sentiment makes investors' reaction to the upcoming earnings release highly unpredictable. The share price might decline even if MSFT delivers another double beat, and the guidance is strong. Moreover, we don't know what political and geopolitical headlines will look like next week, which can also weigh on investors' confidence. Recent developments in the metals market might disrupt some of Microsoft's AI infrastructure projects. Copper and silver are the two widely used metals to build data centers that saw soaring prices recently. If copper and silver prices continue to soar further, it can potentially significantly cool down the power of AI narrative, because higher input costs is likely to make some large data centers much less attractive economically. This factor might also make some of the management's comments during the earnings call cautious, which investors might consider as a sell signal. I think that reiteration of a strong buy rating for MSFT is a reasonable choice, given a quite rich set of positives before the upcoming earnings release and substantial undervaluation. This article was written by KM Capital.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.